Here's another money moment from the Income for Life show with Matt Nelson and Nick Schilling.
The three options for retirement income are very simple. Sadly, there's about 1 million different ways to design each one of these three. But what we're trying to do is we're trying to get just to the core, just the common sense version of how you need to look at your retirement income planning. And there's only three ways. There's only three ways that you can go whenever you're looking at retirement income planning. So let's look at the first one. And the first one we call the bank's way. Very simple. The bank's way to retirement. How could you use the bank's way in today's economic environment when the bank's way rates are at an all-time low, Nick? Well, how would you do that?
When we start to think about these three ways of thinking of how you can plan for retirement, I think the bank way is the one that's hit most right now. With rates where they are, with the 10-year Treasury at just over 1% and a 30-year Treasury bond at about 2%. Think of investing your money for 30 years, 3 decades, and earning 2% a year.
2%. Let's stop right there for a minute because that's baffling to a lot of people that might be listening because we looked these numbers up.
Correct.
Right before we jumped on the show here. The current 30-year bond rate.
U.S. Treasury bond. Yeah.
Was what?
Just over 2%, 2.085%.
2.085. So in order to actually get that rate, which is awful, by the way, 2.085, you have to hold that for 30 years.
The only way to guarantee that you're going to get that rate the entire time is to hold it to maturity, which is 30 years. Yes.
30 years.
Yep.
So anybody that's listening right now is probably saying, my God, why would anybody do that?
Why would you commit to 2% income for 30 years when you have to guarantee it that long? That's not a livable rate.
Not even close, because what is the current inflation rate?
Depending on how you calculate it, the inflation rate is anywhere between 3 to 4% right now. So you're losing 1 to 2% every year just on inflation, even committing to a 30-year interest rate, let alone a 2 or 5 year CD, which is paying less than 1 or 1% right now.
There's an interesting term that you and I talk about on that topic right there. We call that losing your money safely.
Correct.
Because you're not even keeping up with inflation. Okay, you got this 2%, for example. You got to take it to maturity, whatever it might be. Rates are at an all-time low with the treasuries, et cetera. And those rates are not even keeping up with the current inflation rate. So you're actually, some people even call that a moonwalk, Michael Jackson moonwalk account, where you think you're walking forward, but you're actually going backwards.
Correct.
And so we call that bank's way, losing your money safely. So it's just not a proper way to go about in today's world.
You're going to get statements every month and every quarter from the bank, and that same $100,000 or $500,000 that you have in there isn't going to go down. It's going to be going up very incrementally, but you're losing purchasing power and buying power every month and year that you have it in there to the inflation rate. You're not even keeping up with inflation, and committing that amount of money to a safe way of losing it isn't going to work for an overall retirement plan, not an income replacement plan that we need to have to guarantee your lifestyle.
And you're the one that is then responsible for if there's any volatilities or whatever it might be. You're the one that has to deal with that. So the stress that goes along with the bank's way is on you.
The bank's way used to work.
It absolutely used to work.
When rates were normal and you're earning 5, 6, 7, 8, 9% or more, depending on the late 70s and 80s, significantly more than that, but you're also borrowing at higher rates. But when rates are normalized, the bank way can work for some people that want to be able to do it. With rates the way they are right now, it's not a feasible way for most people, and we got to look at alternatives.
That's another money moment from the Income for Life show. And don't forget to subscribe to the show on your favorite podcast app. And if you have any questions for Matt and Nick, or want to get a complimentary financial review, just go to incomeforlife.org. That's incomeforlife.org.